A very important concept is the simple arithmetic average.
A useful number to summarize financial historical data is the simple average. This is also called the arithmetic average. If we add up the returns for large company stocks from 1926 through 2002, we come up with 939.4%. There's 77 returns over those years. The average return works out to be 12.2%. How exactly do you use this number in your investing? If you're making a guess about the size of the return for a year selected at random or the year coming up, your best guess will be 12.2%. The actual formula for historical average return is as follows. Historical average return is equal to the sum of yearly returns divided by the total number of returns. You can use a spreadsheet like this one here to calculate the arithmetic return. Notice that in 1990, the return was negative 3.1%. In 1991, the return was 30.46%. In 1992, the return was 7.62%. In 1993, the return was 10.08%. In 1994, the return was 1.32%. And I can tell you that investors were getting frustrated at the low returns. But then in 1995, the stock market returned a whopping return of 37.58%. In 1996, the market returned 22.96%. And in 1997, investors received 33.36% in their stock investments. In 1998, the market returned 28.58%, and in 1999, the market returned 21.04%. The average percent return works out to be 18.99%. The standard deviation turns out to be 14.16%. We'll talk a lot more about standard deviation throughout the rest of this course. Standard deviation is a measure of return dispersion. If you like to shoot shotguns, think of it as being a way to measure the dispersion of the pattern. Whether or not you have a wide pattern or a narrow pattern matters a lot when you're shooting shotguns.